What is the one question you think that Jamie Dimon and these other executives should be prepared for that they may not be?
Ooh, that they're not prepared for.
Yeah. What do you think the out of left field question will be?
Well, I think.
Or what is your out of left field question for them?
Well, let me give you my best answer. Let me give you the best answers and questions from each side. So I think in terms of Congress asking bank CEOs, I think they can legitimize these hearings with one data point, and that is this decade, savers have lost out on $500 billion of interest due to lower interest rates that are in response to the financial crisis. So if you're moaning about being here in terms of the 7 bank CEOs, there's been a wealth transfer, a historic wealth transfer from savers to others, and that's due to the banks and the crisis. So I think that's the best argument, that direction. The best counter...
What's the answer to that? I mean, there's no good answer. That's just...
Well, that's why you're here. I mean, so therefore, let's make sure it doesn't repeat again. And I think the banks can respond saying, we are the strongest we've been in a couple decades, and there's one metric that sums that up more than anything else, and that would be the bank bond spreads over treasuries have declined from 700 basis points down to 100 basis points. So, Mr. Congressman, Mrs. Congressman, I know you're worried about the health of the financial industry, but I have $1 trillion of bank bonds that beg to differ. So that's
so basically, we're almost as safe as buying a U.S. Treasury bond.
Well, 100 basis points more risky.
Do you think they are safe enough to undo some of the restrictions on living wills? Because that's one of the things that's on the table now.
Well, look, the regulators did a great job, and Jamie Dimon in the CEO letter says regulators should take a victory lap, and he's absolutely right. But the response to the financial crisis was a little haphazard. It was needed, it was appropriate, but now you can do a look back. Do not sacrifice safety and soundness one iota, but you can certainly improve the efficiency of it. You can certainly improve the transparency of it.
And what does that mean? But come back to living wills, because the entire premise of getting rid of too big to fail is reliant on this living will idea, and there is now a move afoot by the Fed to make the living wills a little less rigorous.
Well, I think you need to allow big banks to fail. I mean, that's the whole point. You could almost write a book about too big to fail. That was a nod to you.
Thank you.
But this is a very serious issue. The reality is, if you had one of the biggest banks fail, it's not a good scenario. So you need to prevent that from happening in the first place. So this is more of a thought experiment at this point, because you're not having one of the top 3 banks fail and everything be okay. Having said that, I mean, you've doubled capital, you've tripled liquidity over the last decade, you have the Fed stress test, the banks are strong enough to absorb not just one financial crisis, but 2 financial crises. So it's just a thought experiment at this point.
How much of your bullish case on banks today is about regulation coming down?
Zero.
Zero.
We have zero in our earnings models about regulation coming down. And now, look, you do have the Trump appointees in charge of the bank regulatory agencies. There is some potential for some deregulation, but we're not relying on that one bit.
Do you have in any scenario, a scenario in which regulation increases with a House-controlled House Financial Services Committee, with hearings like we're going to have today? We saw Maxine Waters confront Secretary Mnuchin. It was very testy. I mean, it's a different environment now. There's headline risk.
Wow, I saw that exchange. That was remarkable. I think the importance of today's hearings is that, sound bites have the potential to turn into policy, that have the potential to turn into legislation, and then regulation. So I think this could be a sign of what potentially is to come after next year's presidential elections.
Please weigh in on Warren Buffett's comments over the weekend regarding Wells Fargo and the next CEO of that company. He made the comment that it might be advantageous not to look to a traditional executive from Wall Street, from the Goldman Sachs and JP Morgans of the world, but maybe to look to other places in corporate America, in large part because of the pressure that's coming from Washington.
Well, I will not address comments related to Wells Fargo specifically, but let's look. Wall Street is not Wall Street is not Wall Street. You have 7 banks testifying today. So Bank America, JP Morgan, and Citigroup, by the numbers, if anybody cares about the numbers, they're more Main Street than Wall Street. Surprise. Now, clearly, Goldman Sachs, Morgan Stanley is more Wall Street, and then you have Bank of New York and State Street, which people don't really understand who they are. They're basically a banker's bank. All right? So when you talk about Wall Street, all Wall Street's not the same. Oh, and by the way, JP Morgan, they were a source of strength during the financial crisis. So don't paint the whole industry with one brush. If you look at the testimony, there's 67 pages of testimony that was released yesterday.
Right.
You look at the testimony, and Citigroup and Morgan Stanley, they're talking about how strong they are after coming back from the crisis, and that's right, because both of those banks almost failed, in our opinion. Okay, that's right. And then you look at JP Morgan, though, they're not talking about their strength. They're talking about, quote, inclusive growth. They're talking about being a partner with a lot of constituencies. So don't paint the whole industry with one brush. Wall Street is not Wall Street is not Wall Street. It varies.
What will the catalyst be for bank stocks?
You know what? You have the greatest earnings stability in over 2 decades. You have the strongest balance sheet in decades.
That's great, Mike. And you could have said that last quarter and the quarter before, and it didn't really move the needle.
Well, look, I mean, every quarter, every year, every few years, the banks don't mess up is another justification for a revaluation of bank stocks. So for the first time in my career, going into this year, we recommend all 5 of the wholesale banks. So Citi, Bank of America, JP Morgan, Goldman Sachs, and Morgan Stanley. Our favorites are Citigroup and Morgan Stanley. First time ever. By the way, where were these hearings, in 2005 and 2006 when I was kicked off from being on your show at that time, and I was kicked out of bank CEO meetings, and all that stuff. Where were the hearings? And I actually called up the SEC when I was fired at the early part of last decade. Where were the hearings then? Where was everybody then? So now you're having hearings when the industry's stronger than it's been in decades. But I think it's fair because savers have paid so much. I think it gives a sight into what might happen over the next couple of years. But the industry's doing fine, even with this justified look back.